Hey, in this video, I'm going to talk about the annuity income tax on the variable annuity. Specifically, I'm going to talk about how to calculate the exclusion amount, which is those amount is not taxed. So, have any other implications around it? So, it's a little complicated, but bear with me so you will understand it. Exclusion amount. Okay, so with a variable annuity, the exclusion amount is determined by dividing the investment principal in the contract by the number of expected payment. Okay, let's see an example. So assume Nancy purchased a variable annuity for $240,000. She has life expectancy 20 years at the time payments are to begin. Annuity payments are to be made monthly. The number of anticipated payment is 240. You can see if your payment is monthly, so 12 months for 20 years, you have 240 payments, right? So then your original principal is $240,000. So if you divide your total payment will give you $1,000 per each payment. Think about, right now, say, you know what, I invest in $240,000. So this annuity company gonna give me $1,000 per month for 20 years. So that is exactly return your capital, right? So then this amount, each month you get $1,000 per month is not taxed. So this is called exclusion amount. So this amount is fixed. So doesn't matter how much you're gonna receive the payment. This $1,000 you are not gonna pay tax on it. So you always know when you start taking your annuity payment, you always know the amount you will not pay tax on it. So that's something you should know. So then you have to figure out then which amount is going to be taxed, right? So it's how annuity is structured is say annuity contract owners own numbers of the accumulated units. So those units is like shares in a mutual funds. So basically you kind of own shares in those policies, right? So the value of each accumulated unit may go up or down due to the performance of the underlying investment. So, it's like a mutual funds shares. The share value do go up, down because the investment goes up, go down, right? So this is the same with the variable annuity because you own each unit, right? So when an annuity owner starts taking periodic payments, so the number of the annuity units, so basically is the accumulated unit in each payment is determined using life insurance annuity table. The number of the units remain fixed during the entire payout period. Okay, so you see here. So say you begin start taking monthly payment from the annuity company, right? So they will determine at that point, they will determine how many units will be in your each payment, your each monthly payment. So you can see the number of the unit in each payment is fixed. So it doesn't matter how much the value goes up, down. So the number of the units is fixed. So in that situation, so then you can see the value of the each unit is not fixed, right? Your number of the unit is fixed. So which means, let's say you have 100 units per month. So your value, if it go up, your monthly payment will go up. The value go down, your monthly payment will go down. We'll have to see an example on this. So example is if the value of the separate account. So this separate account basically is for this your annuity policy. So they have the entire value is 25 million. Then have a 2 million accumulated unit. So they can calculate, each unit how much money, how much is for each unit is $12.50. So they calculate, okay, at the point when you start taking your monthly payment, so they calculate the each unit value, right? So then they decide on how many unit you're gonna have. So that's how that works. So for the previous example in the last slide, so the Nancy, you remember Nancy has a $1,000 per month that is retained capital that's not taxed. So now Nancy, has 100 accumulated units in each monthly payment. So her monthly annuity income is $12.50 times 100 unit, give $1,250. So you can see, so at the point, the beginning, when she decided to take a monthly payment, so you can see her monthly payment is $1,250. Because $1,000 is non-taxable, so the taxable amount is $250, right? Then what if the accumulated unit value goes up to $15 per unit? Then Nancy's monthly payment is $1,500 and $500 is taxable. Then if the accumulated unit value goes down to $10 per unit, then the Nancy's monthly payment is $1,000 and $0 is taxable. You can see here, because it's a variable annuity, their monthly payment is not fixed. It's not guaranteed. It's based on the performance of the investment, right? So now you can see this now. In the fixed annuity, we talk about, say, what if in previous example is Nancy's expectancy, life expectancy is 20 years. What if she lives, more than 20 years? So that's coming to the situation that a law happened in 1986. This is same with the fixed annuity in my another video. So you can see here. So basically, if your annuity is annuitized before 1986, so this is a little situation. Say, for the annuity contract that annuitized before December 31st, 1986, the exclusion ratio is applied to the full future payment, even if the annuitant outlives their life expectancy. So for fixed annuity, you call exclusion ratio. For the variable annuity, your exclusion amount. So you can, if you take the if your contract was annuitized before 1986, so you still, even you live beyond the 20 years, your life expectancy, you still can take $1,000 as a non-taxable. So anything beyond that is taxable, right? When you is your annuitization was after 1986, so then it is say, so exclusion ratio is applied to the payment only within life expectancy. The entire annuity payment is taxable if the annuitant outlives the life expectancy or the investment in the contract has been recovered. So basically say, well, in a previous example, Nancy lived more than 20 years. So we know for 20 years, her basis was covered. $240,000 was recovered, right? So if she lived beyond, 20 years, if she received, let's say, monthly payment $1,500, so entire $1,500 will be taxable. Her original the $1,000 exclusion will no longer apply. So in this situation, so that's just something you want to know. So for both fixed and variable annuity, this situation applies. So this is a summary. So entire life income is partial taxable, partial not taxable. If it's before 1986, after 1986, you can see once beyond life expectancy, entire payments are taxable. So that we will talk about this beyond the life expectancy, right? If the annuitant dies before life expectancy and has not completed the recovered basis, so basically say uncovered basis is deductible on the annuitant final or income tax return. So this is something you want to know. Okay, so last thing, just to say, in previous example, Nancy was, initial investment was $240,000, right? So that's the original principal, the capital she put in. What if this is called the investment in the contract? So if she didn't do anything after that, but some people, they may take withdrawals from the policy. So that time, for you start annuitize is based on the rest of the amount. That's called investment in the contract. For both fixed and variable annuity calculations, the investment in the contract is the net cost of the contract as of the annuity starting date. So this is the total amount of the premium paid reduced by the distribution that will exclude from the income. So you can see, so total premium you paid minus the any distribution you take. So that will be the amount you will be used to calculate your calculate your exclusion ratio, all those things, right? So you can see, assume that Mike had an investment $200,000 in pre-August 1982 annuity contract. In 1999, he took a non-periodic distribution, $25,000 when the annuity payment began. The investment contract was $175,000. See, he put a $200,000 in, then took a lump sum distribution, $25,000. So then the rest left is $175,000. So you would use the $175,000 to calculate the exclusion amount, right? So yeah, that's just something you need to know.